Hi, this is Kribakaran Rajendran, founder of Algo Trading from squareoff.in. In this video, we'll be covering about how successful traders trade differently. What differentiates between a guy who is getting started with system trading or a guy who is complete beginner versus a guy who have been trading for quite a long time. So that is what we'll be checking out. So in that, we'll also cover like how do they create specific trading strategies, what are the things that they focus on when they are creating a trading strategy, and what are the three main pillars or factors that needs to be considered to become a consistent trader or consistent profitable trader. And we'll address a specific trading strategy in an intraday trading strategy which is called as 1% short straddle strategy. I'll explain the rules behind it and how it has performed well in the consistently for the past 6 months. I'll explain those part, and also I'll explain how that specific trading strategy can be deployed as a trading bot and can be traded completely at free of cost. And also I'll explain what are the various different bots that is available at Square of bots and how each bot would perform on different kind of trading days or different kind of market environments. So these are the things we'll be addressing in this video. So before I begin to give a brief intro about myself, my name is Kribakaran Rajendran. I have worked with companies like Infosys, Bank of America and other IT companies for 10 plus years, and then I quit my full-time job to become a full-time trader and to focus on my startup. And I have written almost 1200 plus articles related to trading and investing that has crossed more than 15 million views. So you could see all those articles related to trading, investing, system trading and mechanical trading in a platform called Quora. So that is where I have shared most of the informations. And I've trained more than 10,000 plus traders on trading systems and other various aspects related to mechanical trading systems through webinars and other platforms like LearnUp and eLearn Markets, etc. And I've started Square Off in the year 2017 after I quit my job, where we started giving trading bots as a SaaS kind of a service where we charge users based on subscription model by giving them an inbuilt basket of strategies through trading bots. And I've also featured in Money Control Money Control, where they feature the top traders in India and publish the information in their site. So this is to give a brief intro about myself. So we'll get started with the session. So the first thing is creating a trading strategy. Is it really easy or is it really hard? So if I ask any users right now, currently creating a trading strategy is relatively easy compared to 10 years before, because even in 10 years before when I started doing the systemized trading, if I have to check whether a specific logic would work or not, for an example, if I wanted to buy a specific stock which breaks its previous day high and I wanted to sell it when it breaks previous day low, if I have to test this simple logic, I have to write some 50 to 60 lines of code in platforms like Ami Broker, Ninja Trader and other charting tools. So it would you need a coding skill and you need those historical data to backtest your ideas. But now there is multiple platforms like StockMock, AlgoTest, Tradewdown, Quantman. So these are the platforms where you could backtest your trading ideas with a click of a button, where you really do not need to know about coding. You can simply give a logic using a drag and drop feature and it just gives you the output. So it is just like how we are currently creating websites. Like 10 to 15 years before, if you have to create a website, you need to know coding. Otherwise, you cannot create website. Now, anybody could create a website with simple drag and drop functionalities with no code platforms that is available. Anybody could create it. So similarly, now creating trading strategies also relatively as made simple, but creating a trading strategy which is not curve fit, which works for a longer period of time, which is really profitable, and having which is generating a decent returns with a lesser drawdown, all these things are really hard. So creating a trading strategy is easy, but creating that trading strategy which really suits you and makes a consistent returns over a period of time is really hard. So when you create a trading strategy, like you have a specific logic and you wanted to create a trading strategy, or you just started with mechanical trading systems or rule-based trading and you wanted to create a trading strategy, these are the certain things that you need to keep in mind when you're designing a trading strategy. You need to be realistic. Like you should have a clear-cut expectation with what kind of returns that you could generate with respect to trading. And the next thing is you should know what you really do not know. So you should know your strength and weakness, just like which is really essential for any of the career opportunities. Just like that, with respect to trading strategy, you should really know what you are good at and what you're not good at, and then you should know what kind of system would really suit you. So you should know your own personality, and then you should define the rules clearly. So you can't simply state that I would buy a stock when it forms a head and shoulder pattern. Those things are not quantifiable, those things are not clearly defined. And then you need to backtest your trading strategy. Obviously you need to test whether a specific system would work or not. So backtest is not going to obviously guarantee that it is going to give you similar kind of future profits, but the idea of backtest is to tell you, okay, whether your logic has really worked in the past or not. If it did not work in the past, there is an 100% guarantee that it would not work in the future at all. So it gives you a sense of validation whether your logic would make sense, would work, or does it really worked in the past or not. And once you backtest, you can't become excited and put all your capital and directly trade that specific strategy. You need to forward test it. You just need to test it with one lot or two lots and try out whether it is matching with your backtest or not. Because most of the specific trading strategy, if you're using a very minimal stop losses, it could give you great returns in backtest, but when you deploy that in live, you won't see the similar returns, because there could be a vast difference between the slippages and what price it got executed in real time versus at what price it was showing in the backtest. So you need to forward test it for a couple of months to make sure that there is no big deviation between backtest and forward test. Once all these things are done, then you are ready to go live with a higher capital. So when I said that you should have a realistic returns with respect to having a trading strategy, see, these are some of the well-known investors, well-known traders who have been trading based on quantitative analysis. Like Jim Simons is one of the greatest hedge fund trader out there who trades completely based on data-driven statistics and other mathematical trading strategies, which he applies on Renaissance Technologies. And all these people who are enormously rich, who's managing billions of dollars, if you check their average returns, it varies anywhere between 20 to 30%. That is the average returns that they are able to make over decades of periods. With their experience with such kind of billions of dollars, if their expectation is to make 20 to 30%, then that is actually the realistic expectation that we should keep with respect to trading. So be it investing or be it trading, with respect to trading, it doesn't really matter whether you are generating 100% returns or 200% returns. If you are generating such, or if your strategy is capable of generating 100 or 200% of such wild returns, you should also know on what basis of risk it is generating. So if I'm generating say suppose 100% returns, but I'm facing a drawdown of 60%, then that doesn't really make sense at all, because you could lose more than half of your capital at any point of time. And 90% of the traders who lose faith in that specific trading system when it goes down more than 60%. So obviously you're not going to make it up. So you should have a realistic expectation where your drawdown shouldn't exceed much, it shouldn't deviate much. So when you say, okay, I'm mentally prepared to handle a 30% drawdown, then it actually means that you are only ready to handle 15% drawdown. So the moment half of your drawdown is reached, so if your backtest says 30 and in real time if you reach 15% drawdown, then psychological issues come into picture. Like you will start doubting your system, whether it actually would work continuously or not, or you would think whether the market structure has completely changed probably. So probably I may need to change my system or tweak my system. So all this thought process would come into your mind when your system goes underwater for a prolonged period of time. So when you have a realistic expectation like 30% a year with 5% or 10% drawdown, then it means that you are just risking 10%, but you are making almost 30%, 3 times of your risk by the end of a year. So this will make you stick to the system over a longer period of time. So it doesn't matter whether you are making 80%, 70% or 90%. You need to make sure your drawdown is not so much, because you would not stick to that system if your drawdown is so much. So when you wanted to deploy a strategy, or when you're designing a strategy, or if you're subscribing to some other strategy, do not mainly go based on the total returns. Find out what is the drawdown of that system and divide the drawdown divide the overall total returns by drawdown. Say suppose if that specific system is giving you 100% returns, and if the drawdown is 50%, divide 100 by 50. So whatever the ratio, that is your ratio. So if this ratio is higher, then that means that the system is more robust. So a system which is having 100% returns with a 50% drawdown, the ratio is just 2. Whereas if the system is having 100% returns but the drawdown is just 20, then the ratio is 5. So the ratio which is having 5, that is the good system where you can go with. So do not simply go based on the overall returns. Find out what is the returns versus the maximum drawdown. Accordingly, you could finalize the system and go for it. And other than that, you should also look for a system which doesn't stay in underwater for a prolonged period of time. Say you have a good system, but that specific system has been underwater for a prolonged period of time, which means it is not making a positive returns for 3 or 4 months. Then in that case also, you will start doubting the system. So make sure the number of days that this specific system is in drawdown is also relatively lesser. So there is this interesting story about Mahabharata which I recently listened to in one of the Tamil podcast, where they've explained why Duryodhana won the gamble bet but Dharma lost it. It is because Duryodhana won because he knows that he did not know how to gamble. So he used his uncle to play the sport or to bet it. Whereas Dharma didn't know the game, so he completely played the game and lost it. So this is really, really important with respect to trading, or be it whatever it is. But with respect to trading, it is really important because you should know what you do not know. If being an equity trader, I have been trading for a couple of years and I really know about equity markets. But with the same kind of knowledge, if I get into a cryptocurrency, definitely I would fail, because cryptocurrency involves altogether trading a Bitcoin, trading a Ether altogether requires a different kind of mindset, different kind of trading strategies, which I completely lack. I do not even know what cryptocurrency is all about. So I could be make a profitable trade here and there, but I cannot make a consistent returns. I cannot replicate my success which I could do it in equity. I cannot do it in the other markets unless and until I really know about it. So if tomorrow I wanted to trade a natural gas or crude oil, I wouldn't do that, because even though my trading system says, okay, if you do this specific strategy, it is going to generate higher returns, I won't do that, because because I do not know anything about commodity markets. And second thing, commodity markets in India is there till 11:30, so I do not want to spend so much of time after 4 or 5 o'clock. So you should really know what you're really good at and what you do not know. That is most important part with respect to trading. So find what suits you. So accordingly you design a strategy, or accordingly you adapt to a specific existing strategies, or when you're subscribing to a strategy, find out what kind of personality you are, and accordingly you choose those kind of strategies. For an example, if you are a full-time a guy who is going for a job or who is running a business, who do not have time, then in that case doing a manual trading with respect to intraday doesn't make any sense at all, because you need to sit in front of a system, monitor all the charts, watch all the movements to make a buy or sell decisions. But with your existing job, it would be really difficult. Whereas if you're going for an algo trading or subscribing to that service, it's altogether a different game. But you, as a person who wanted to trade for yourself based on your own strategy, then it doesn't make sense, because you can't spend your time with respect to markets doing all the analysis. And next thing you have to check out is, are you a person who is ready to take a small profits over a period of time and ready to lose higher amount of money in one single trade, like mean reversion trades, or people who are short selling and OTM options. They make little profits, but once in a while they lose big. So you have to find out whether those kind of systems would really suit you or not, and you have to find out whether you are an intraday trader or a positional trader. So for intraday trading, it's all about like whatever happens between 9 to 3, that's it. There is no overnight gaps associated with it. With positional, there is a risk of overnight gaps where a position can completely go against you. Are you prepared for that? Did your do your position sizing be considering all those gaps that has happened in the past, and also that just not happened in the past? So sometimes it could go in your favor, sometimes it can't go in your favor. So you have to decide whether this is suitable for me or the other one is suitable for me. Similarly, when you are choosing a specific trading bot or trading strategy, find out what is the nature of that specific bot or trading strategy it is. If it is a trend following strategy, then the rules of a trend following or breakout strategy is buy higher, sell even more higher. Like it would, from 100 rupees, if it goes to 105, you buy it expecting that from 105 it is going to go to 110 or 120. So because you are expecting, after your entry, you are expecting this prices would start moving up even further, so that you could get out of it. Or you have to see whether you are a person where you see, okay, yesterday's stock was trading at 110, today all of a sudden it dropped 10% and it is currently trading at 100 rupees. Now it seems to be a good bargain buy, so let me buy it at 100, so that if it again goes back to its previous higher levels, I would sell it. This is kind of a mean reversion strategy where you wanted to buy low and sell high. So you have to decide which one is really suitable for you. And if you're trading with commodities markets, obviously you need to have a higher time, and you need to put in so much of effort and time in getting to know about commodities markets. Only then you could get into it. So you need to find out what kind of personality are you, and accordingly pick up those kind of strategies or pick up those kind of trading bots. And if you do that, then there is a higher chance that during the rough phases you would stick to these bots or strategies. So the main output that you see in the back test, the overall results or the overall performance that you see, okay, in 1 year this is the total returns this specific strategy has given. So if you have to accept that, or if you have to achieve that, you need to sail through the rough phases. So the only way you would sail through those rough phases is only when you are able to stick to the system. And the only way you could stick to the system is if it really suits your personality. So initially when I said, okay, you are ready to focus on all the aspects and you want to define a trading strategy, so you can't simply go with parameters like head and shoulder pattern or cup and saucer pattern. All these visual chart patterns cannot be quantified clearly. So you should clearly know what is the rules. Like, say suppose the one that you see on the screen is kind of a short straddle strategy, which tells me, okay, I need to short at the money call option, at the money put option, where I can define target, I can define stop loss, or I can even define my trailing stop losses, and I'm specifying this is my entry time, and also I'm specifying this is my exit time. And if something goes wrong, this is where the moment it reaches this kind of losses, I'm going to go out, or the moment it reaches this kind of profits, I'm going to come out. So everything is clearly defined here. So when you focus on rule-based trading, you shouldn't decide what needs to be done next after you enter into a trade. Everything is predefined before even you get into a trade. So that is what rule-based trading is all about. There is three major pillars or factors that is associated with being a consistent rule-based trader or mechanical trader. So the first thing is trading strategy, obviously. So 95% of the traders do not follow a trading strategy. Even I myself, when I started trading in 2008, from 2008 to 2014, it took me almost 6 years to realize there is something called rule-based trading. Because all those 6 years I was just trying to dabble multiple things. Like, I'll look some moving average and I see, okay, if it goes above that, I'll buy, or I'll check recently what happened in the market, and based on those recency bias, I'll have my own trading decisions. Or whenever some specific stocks are being discussed in CNBC channel, I'll just buy those stocks stating that it has gone down recently and expecting it to go up in next couple of weeks. So all my trades were completely random in nature, and that is also was a reason where I couldn't make any profitable output during those early phases. So many beginners, when they say that 95% of the traders are not making money, it is mainly because they lack a process. So only when there is a process, there will be a progress. So obviously you need to know what are the set of rules that clearly defines you, okay, this is what needs to be done. When these conditions are met, I have to get into a trade. So once you have these rules clearly defined, then that is what you call as a trading strategy. And once you follow it, the 95% of the problem is solved. And the next big thing is, there are a set of traders who says that, okay, I still do have a trading strategy, but I still find it difficult to sticking to that specific trading strategy. I've read multiple things, I have tried multiple things, but I couldn't follow a single specific trading strategy because I lack discipline. So this discipline is like, why do they say that, okay, trading is really hard, is because you could find n number of trading strategies out there. It is not the trading strategies that is lacking in the markets. There are a number of strategies out there, but it is the discipline with the trader, that is what it is lacking. So you can have a beautiful trading strategy in your hand, but if you're not able to handle 3 or 4 continuous losing streaks, obviously you're not going to get that end output, the end profit that you've seen in the back test. So the discipline comes only when you know how much is too much, when you have the right position sizing. So it means that, say suppose I have 5 lakhs of capital, and if this 5 lakhs of capital is really crucial for you, which means that I got this 5 lakhs because of home loan, or I got this 5 lakhs because of my 7 months of savings, or this is my hard earned money. So when you have so much of emotion associated with your capital, and that too when you feel that that is really big, expecting that okay, I've seen the backtest, it is making 100%, so I'm ready to put all my capital of 5 lakhs so that I could make this 5 lakhs into 10 lakhs. Because when you have these kind of thought process, as long as it goes in your favor, it's fine. But the moment it's not going in your favor, you will have so much of emotional interference with your system. So even though it is algo trading, people say that algo trading removes emotion, but it would not remove emotions at all. Still it would come and interfere with your mind. Say suppose even though you deployed your capital into an algo based strategy or a strategy provider, still the on and off pulling the trigger is in your hands. So anytime you could see okay, then the market is going against me, if I wait for the algo, then it would completely wash away my profits. So let me interfere and stop the algos and book some profits here. So these kind of interferences would come in when you're trading with a bigger position size. So if you're completely newbie, or you're just getting started with the market, subscribing to an algo service or with your own trading strategy, do not put all your capital and test it out. See, our expectation with respect to markets during our early phase is not to be making a higher profits with shorter span, or not to make so much of profits in short span of time. Our initial expectations should only be focused on the process. Am I sticking to the process? Am I following the trading strategy 100% without any interference? So if you are so good at following the process at least for 1 year, then you don't need to worry about anything at all. So forget about putting 5 lakhs, just put 1/5 of it, just put 1 lakh, or trade with just 1 lot instead of 5 lots, and do not worry about the outcome, because 1 lot is not going to be a bigger interference for you, or it's not going to be a big deal. So if you trade only with 1 lot for the complete 1 year, then that gives you a good perspective towards market. Okay, this specific strategy, when the market is moving up, this is how it would do. When the market is moving down, this is how it would do. Or if the market is completely volatile, this is how this strategy behaves. So you get used to all these kind of fluctuations over a period of time, so you would be able to stick to that strategy for quite a long time. So instead of 5 lots, a guy who's trading only with 1 lot and complete one strategy for the 1 year, he will have a higher probability in making success in markets over a longer period of time. So that is what it is essential. So you should have a trading strategy, and you should have the right discipline to stick to the system. And third thing is, you should know how much is too much. So only when these 3 things falls together, you would be able to become a consistent profitable trader. And this is one of the most important questions that I always get from the many users or many people I interact with. The first thing that they ask is, what is the winning accuracy of your system or your trading strategy? So how many of you think that okay, winning accuracy is really important? So I'll give you 5 seconds. You could post it in the comments. Do you think winning accuracy is important with respect to trading strategy? Okay, so if you thought okay, winning accuracy is really important, then no, it's not really important. So all that matters is how much you make when you're right and how much you lose when you're wrong is all that matters. So even a George Soros, a legendary trader, once said that winning accuracy is the least important factors with respect to trading. So even I'll tell you, explain you with this example how 3 different trading strategies can be compared with. See, the first one you see on the left hand side is a specific trading strategy which is having a 90% winning accuracy. The second one is having only 10% winning accuracy, and the third one is having a 50% winning accuracy. So these are the winning accuracy of 3 different trading systems. Now consider the first system, which is having a 90% winning accuracy. It is like those shorting and OTM options on expiry days. For an example, on expiry days, when the markets is about to expire by 3 o'clock, there you could see a lot of OTM options which is trading at 1 rupees, 2 rupees or 5 rupees. So there is a higher probability that this OTM options would expire worthless as long as the market stays flat for the next 30 minutes. So now most of the options sellers, what do? They short this penny premiums. So they short at 5 rupees or 10 rupees expecting it to go to zero. So when they do that, they are able to make a little profit. So the average profit on this trade is, say, suppose 1000 rupees. So for an example, we are considering when you're right, you are making 1000 rupees. So these OTM options, 90% it would expire worthless, but those 10% of the time it could move wildly. Even after 3 o'clock, Bank Nifty has made multiple wide moves. So those periods you could lose a lot. Like you could see those 2 rupees, 5 rupees option moving to 50 rupees, even 200 or 300 rupees. So you are 10 times or 30 times it goes up against you. So out of 10 trades, 9 trades you are happy, you are making profit, but the 10th trade it ends up in higher losses. So when you do the calculation summation, okay, after 100 trades, if you follow this 90% winning accuracy trading system, it ended up in a negative returns of minus 10,000. So your average profit is 1000, your average loss is 10,000. So even though your loss happens just 1 out of 10 trades, your losses are much higher than your average profits over 100 trades. Because of that, this system which is having a 90% winning accuracy is not a profitable system. So if you are just having a recency bias towards it, okay, in the last 4 expiries I was able to short these OTM options without stop loss and able to make money once in a while, or eventually it would happen. Definitely when that happens, it is going to wipe out all your profits and put you in a big loss. So it is not recommended to focus on a specific strategy which is having a 90% winning accuracy. And the second one is having only 10% winning accuracy. Even this Richard Dunn is the famous turtle trader. Their winning accuracy system, where they made millions of dollars back in 1970s and 80s, their winning accuracy is less than 30%. But whenever they are right, their profits are so high than whenever they made losses. Because of that, they were able to make millions of dollars. But even with 10% winning accuracy, this system has given a positive expectancy results. So consider the same OTM options. So instead of shorting, we are buying this OTM options, because you consider, okay, in the recent past, that specific option has moved from 5 rupees to 50 rupees in just few matter of time. So we expect that, okay, it can go high, and so you are buying those OTM options on expiry days, expecting it to go high. But out of 10 trades, only one time you are going to be right, remaining 9 times you are going to lose. But you are saying, okay, it is fine, because after all I'm just paying 2 rupees or 5 rupees for the premium, I'm okay to lose it. But you have to lose 9 times, and only one time it will give you huge profits. Definitely it's going to give you huge profit. The average profit is 10,000, average loss is 1,000. So you are losing little every time, and when you're right, you are making 10 times of your average losses. So after 100 trades, this system, which is having only 10% winning accuracy, is giving you higher returns. So practically this is really a good system on when you see in a back test. But when you're doing it practically, you have to ask yourself, will I be comfortable enough in seeing back to back losses of 9 consecutive losses in order to take that one single profitable trade? It is really difficult. So the moment we see 3 or 4 losses, we'll start doubting the system and we'll fail to take the next trade, which might end up giving a huge profits. So that is a practical difficulty. And the third one is the most widely acceptable trading winning accuracy, which is 50%. If you take any breakout trading strategy or any trend following strategy, the average winning accuracy varies anywhere between 35 to 45 at the max. Any main reversion or strategies like 920 straddle and other strategies could give you anywhere between 60 to 65% winning accuracy at the max. But if you see, the average profit per trade here is 2000 rupees. Average loss that you face in a losing trade is 1000 rupees. So your profit is 2 times of your average losses when you're right. So this specific system, after 100 trades, has given 50,000 rupees overall profits. So all 3 different trading systems, which is having different winning accuracies, has given different outputs. So the one which is having a 90% winning accuracy system might not give you the desired profitable scenarios. but the one which is having just 50% winning accuracy is given the highest output. So you shouldn't focus only on the winning accuracy, you should focus on the risk reward ratio, how much it is made, overall expectancy is what you should focus on. So as long as it is having a positive expectancy, you can go with it. If it is having a negative expectancy, you should just drop the trading strategy. And the next one is losing streaks probability. So most of the people underestimate this. Say suppose they see, okay, I have backtested trading strategy, and in the backtest it shows me that it has given only 3 consecutive losses. So I have no big deal, because the backtest has been done for 3 or 4 years and I have never seen more than 3 consecutive losses. But if you run a statistical analysis on a losing probability, the table that you see is nothing but what are the winning accuracy of a system and what could be the probable losing streaks. So a trading strategy which is having a 60% winning accuracy can give you 12 back-to-back losses. So not 1 or 2, it can give you 12 back-to-back losses. Even a system which is having 90% winning accuracy can give you 5 back-to-back losses. There is no such system which is having 90% winning accuracy, obviously. So the actual expectancy would be between 45 to 60 is what most of the trading strategies winning accuracy are. So if you see that, so your maximum continuous losing streaks could be anywhere between 12 to 18. So when you are having these many losing streaks, if you are trading with the under capital, like if you are completely not having the desired or enough capital to handle these drawdowns, you will be you completely will blow up your account, or you would not be able to take the next trade after all these continuous losing streaks. Whereas if a person who is risking just 1% in a trade, so if he is trading this kind of a system, even after 12 consecutive losing streaks, he'll still have enough money, because at the max he's going to lose only 12% of it. So you have to decide or plan your capital accordingly. Just because a specific trading strategy requires you a margin, for an example, if you're trading a short straddle strategy which might need only 1.5 lakhs of overall margin that needs to be blocked by the broker, but if you do not have additional capital to handle all these drawdowns and back-to-back streaks of losses, then definitely you are going to be in trouble. So that is why we always recommend our users to trade at least with 2x of what the margin is required. For an example, for all F&O trading bonds, we have recommended our users to trade with 3 lakhs capital. Even though if they have 1.5 lakhs, the order is going to get executed, but still you are having additional 1.5 lakhs to handle all these drawdowns and losses. So that is how you need to plan your money management. So now we'll focus on the trading strategy, which I said initially that I would be sharing the details. So this specific trading strategy is what we call it as 1% short straddle intraday strategy. So it primarily trades on Bank Nifty and Nifty, where we have actually deployed this as a bot. I'll explain how to use the bot at the later point of time. First, I'll explain the rules behind it. So we know the famous 920 short straddle strategy, which is nothing but usually having a fixed stop loss associated with your straddle. Say suppose I'm entering a short straddle strategy at 920. I'll have a fixed stop loss of 25% on call side, 25% on put side. When any of the stop loss is hit, I'm going to close it and I'll keep the remaining stop loss open, remaining leg open. It is going to make profits eventually as long as the market goes in one side direction. So the problem with the 920 short straddle strategy or having a short straddle strategy with a fixed stop loss is, if the market moves zigzag, then your stop loss could hit on both sides, and that is where you are going to lose money. So as long as the market moves in single trending phase either on the upside or downside, these kind of short straddle strategies with a fixed stop loss would work well. But if the market turns volatile, like which it has happened in the recent past, then it is difficult to make profits with such kind of strategy. So in order to counter that, in order to handle that, we came up with this 1% short straddle intraday strategy, where we don't use a fixed stop loss into the system. So we don't put a stop loss pending order into the system. Instead, what we do is we check, okay, we place the short straddle strategy, we short both call option and put option at 930 and wait for the index to move 1%. So we check, say suppose if Bank Nifty spot is trading at 30,000, we short 30,000 call, we short 30,000 put, and wait for the Bank Nifty to move from 30,000 to 1%, say 30,300 on the upside, 29,700 on the downside. So we wait for the market to move on either side. If it crosses that 1%, then we completely exit our positions, both call and put. If it doesn't cross, then it means that the market is stagnant or it is trading in a range bound. So if the market doesn't move 1% from 9:30, which means that market is trading in a tight range. So that is where the decay happens on both call and put, and we end up making profits. Those are the periods you might lose money on having a 920 short straddle strategy, or another a short straddle having a fixed stop loss. Since we don't use a fixed stop loss here, we are completely making profits because of the decay. And if the market starts trending, we are coming out with a fixed stop loss. So when the market is completely trending, our losses are capped to a greater extent with this strategy. Whereas the 920 short straddle strategy, which is having a fixed stop loss, those strategy could give you a huge profit when the market is trending. So these two are completely uncorrelated strategies with each other. When deployed it together, it gives you a good equity curves or good returns over a longer period of time. So let us see how it has made profits in the last couple of months. So if you see, this is how the market has moved from 9:30. So we have taken all the historical data of Bank Nifty index and seen how much Bank Nifty moved from 9:30 to at the max how much downside it has moved, and also from 9:30 how much the max it has moved on the upside. So as you could see, the maximum n number of frequency or n number of times, both on the downside and on the upside, this specific Bank Nifty index did not go beyond 1%. So there are only few occasions where it has gone beyond 1%. Most of the other occasions it did not go where it was trading between this 1%. So there was a higher chance that this specific strategy could end up in profitable scenarios. Even we checked it on a day wise, Monday, Tuesday, Wednesday, Thursday and Friday, and we could see more than 55% of the time the stop loss was not hit, which means that the Bank Nifty did not move beyond 1% more than 55% of the time. And even when we deployed it in live in July, and this is how it has performed continuously, like from July to till date, after all the charges, like we have included brokerage, transaction charges, clearing charges, STT, GST, SEBI, stamp duty. So after all, this is how the net PNL has looked like. So it has made a very good consistent returns over the past. And next good thing is, this is going to be just one trade per day. So we are just initiating one short straddle at 9:30, and if market moves 1%, we are just closing the trade. So your transaction cost is considerably reduced as well. So this strategy has been deployed with respect to Square of trading bots, where people who are opening an account under Square of referral, which we have included in the description link. If you open an account under us, you get this bot at completely free of cost. Addition to this, you get two more bots. So 3 bots you get it for free of cost if you open an account under LS Blue Square of referral, where you can trade the same 1% short straddle strategy with respect to Nifty as well as Bank Nifty, and also you would be getting a free option buying bot, which is based on golden ratio bot, which triggers option buying. So I'll explain how this specific strategy can be deployed with respect to bots. So you just have to go to squareofbots.com, which would take you to the portal like this, where you can just click on login. And once you click on login, it would take you, to the dashboard. It would show you what are the list of bots, list of brokers that are available. You just have to select your respective broker and click login. So once you click on login, it would take you to the login dashboard, where you just have to log in using your credentials. And once you log in, it would take you to the algo dashboard that would display the basket of strategies. So just like small case where you can choose the basket of strategies for investing, we have basket of strategies for trading. So everything is completely intraday based. So if you click on this filters here, if you click on option selling, then it displays what are the list of strategies that are under option selling. Say suppose the 1% short straddle bot, that which I explained. So you just have to come here and click on input capital and just mention the number of lots that you wanted to trade. Suppose I wanted to trade 2 lots, I just enter 2 lots and click on trade. That's all. The bot would be in running state, and whatever the orders that are being placed by the bot, you would be able to see, okay, this is the strategy or this is the bot which triggered, these are the orders and these are the price. So you would be able to see all these things in the orders dashboard, and also you would be able to see the same in your actual Alice Blue portal also. So there is Nothing else that is required. Once you come in and you can just pick up whatever the bots that you wanted to trade, whether it is option selling, or if it is futures, you can select whatever the futures, or if it is stocks, you can select okay stocks. These are the bots where you can trade for stocks. So it is completely segregated into multiple different forms. So the only requirement is every day between 8 o'clock to 9 o'clock. So that is where the slot gets open for giving an input. Prior to that, we can't give input because the token gets expired in 24 hours. And yes, login to the bots every day is mandatory because the token would be valid only for 24 hours. After that, it expires. So what the users do is they just come to this specific portal after 8 o'clock in the morning, and they just give whatever the number of lots that they wanted to trade. So we have mentioned what is the recommended capital for each and every bot. So you see what is the recommended capital, accordingly have that capital in your account and give input to the bots. So once you give inputs, then it would automatically take your input, and whenever those execution happens, automatically it would get triggered. Even if you wanted to square off your position manually during any time, see you have placed an order for short strangle, and you see by 10 o'clock or 11 o'clock you made good profits of 5,000. Now you wanted to keep this strategy running, and this strategy you wanted to square it off, then you can just click on square off. This would automatically square off the open positions. So now currently there is no positions that is there, so it is showing error. But when you have an open position, you would be able to square off your positions. So that is how it works. So with respect to the Algo dashboard, all they need to do is go to squareoffbots.com. You can do it from your mobile or from your laptop. It works anywhere. You just have to go to your browser, and you just log in using any of the brokers, authenticated, come to this dashboard and select whatever the bots that you wanted to trade and give input. That's all. It would automatically start firing the orders in your account. So this is the last slide that I wanted to cover, which is really important slide. This is the most important thing of all the things that we have discussed so far. Drawdown is nothing but there are, no matter what kind of systems that you follow, or no matter what kind of trading strategies that you create, or what kind of trading bots that you continue to use on every day, there will always be period where it could go out of sync with the markets. So there will be periods where it can give you negative returns, or it does not make any positive returns for weeks or for months also. But eventually it would come out of that zone and starts getting into a profitable zone. But there will always be period of underperformance. So the one that you see in front of you is a chart, is from a famous hedge fund analyst called Bill Dunn. He manages a portfolio of funds where this is a Dunn composite performance fund. The blue line is actual fund performance, and red line is the actual index returns. So he has been running a trend following strategy from 1970s. So almost 40 to 50 years he has been running a system without much changes. But he was able to beat the index to a greater extent. But if you observe closely, you could see there are more than 12 times he has seen greater than minus 25% drawdown. So which means that his account could go down more than 25% at multiple times. Even if you see during the 2008 and dot-com bubble period, he has lost more than 40 or 60% during those periods. And whatever the money that he has lost, eventually it got recovered. But he has the capability to stick to the system without changing any rules and taking each and every trade during those drawdown phases. Because of that, he was able to come out of it, and not only was able to recover the losses, he was able to make higher profits. So nobody could escape from drawdown. Drawdown is just a part and parcel of trading strategies. That is a part and parcel of rule-based mechanism. So just because you are not able to make money in a week or in a month, definitely if you have that kind of mindset, then no trading strategies would help you out. Any kind of trading strategies will always have these kind of losing phases. So the moment you zoom out and have an expectation, okay, I should check overall returns on a quarterly basis or on a monthly basis, then that is going to give you a positive returns. So I guess I have conveyed most of the things which I wanted to convey in this session. So if you guys have any specific questions, you can reach us at support@squareoff.in, and if you have any queries with respect to whatever I have explained, you can post it in the comment section. I'll address it. Thank you.